let's rock. Let's get it on to topic number 2, which is exit tax. So Debra Rudd, CPA, works with me and has for a long time. We've done hundreds and hundreds of exit tax games. No, they're not games. Anyway, Debra's going to talk about exit tax and pre-planning for exit tax specifically, and away it goes.
All right, hello everybody. So today, talking about planning to minimize exit tax. And I have a little table of contents here. I'm not going to read through it, but this is everything we're going to cover today. We're going to go over 3 sort of main techniques for minimizing exit tax. Just to start with a little bit of context to begin. When I'm talking about expatriates, I'm talking about the tax meaning of the word expatriate. So that means people who terminate citizenship or long-term resident status, the way it's described under 877 Cap A. I'm not referring to US citizens living abroad. For tax purposes, they just keep filing, reporting as if they lived in the US. And a little bit of context about why people expatriate. I've worked with a lot of people who are planning to expatriate, and it kind of boils down to 2 main categories in my experience. One is practicalities, tax compliance burden, having to file tax returns in 2 countries, foreign banking headaches. If you're a US citizen, you can have trouble getting accounts at foreign banks, which can be a problem if you live in a foreign country. Cross-border tax complications, basically meaning, places where foreign tax credits don't work perfectly, or, one country's laws, usually the US, is a little bit more punitive than the other country. So, you end up with an abnormally high rate of tax on some types of income items. The other thing I see very commonly is emotional drivers. Things like desire for simplicity, lower stress, better life. Matching citizenship status to identity is often a big one. And usually when I talk to people who are planning for expatriation, they'll mention 3 or 4 or 5 or 6 of these factors for why they're choosing to expatriate. It's a really, really big decision. And so usually there's a lot of things stacked up for why someone is actually going to go through with something like this. And when you expatriate under the tax meaning of the term expatriation, the IRS is going to want things from you. First of all, paperwork. You have to file Form 8854 if you're an expatriate. Often you'll be filing a dual status tax return, but not always. If you're a covered expatriate, and we'll go over that in just a minute, you will be dealing with exit tax. And also if you're a covered expatriate, the IRS is trying to close estate tax loopholes with Section 2801 and brand new Form 708, which I think is going to be in effect for 2025. There's a draft version of the form out, and I'm expecting to see a final version later this year, early next year. So how expatriation works, this depends on being the right type of person who has the right type of event, where Section 877 Cap A applies, and then you check, is this going to be an okay thing, or is this going to be a painful thing? And the consequences of expatriation are determined by your status. So if you're a lawful permanent resident, green card holder, and you've had that green card for a sufficient amount of time, that makes you a long-term resident. If you're a long-term resident or a citizen and you give up that status, that's your expatriation event. That makes you an expatriate. If you're an expatriate, you have to look at the 3 tests for covered expatriate status. Ideally, and this is kind of the point of everything I'm saying today, if you're a covered expatriate, check your status for those 3 tests before you expatriate. That's the whole point of all this. And if those 3 tests indicate that you're covered, then you're gonna be dealing with exit tax in section 2801. And if they indicate that you're not covered, then you're just an expatriate. You're still filing form 8854, but you're not dealing with exit tax in that case. So under the tax definition of expatriate, this is any United States citizen who relinquishes citizenship or any long-term resident of the United States who ceases to be a lawful permanent resident of the United States. Couple similar sounding terms in that second one. So this is what is meant by a long-term resident. If you have the green card for enough time, that makes you a long-term resident. And enough time is 8 in the last 15 years. And it's in 8 of the last 15 years, meaning not for 8 years, but during 8 years. So if you have the green card for just a week or a day in any given year, or of the last 15 years. And the most common expatriation events that I see, there's certainly others, like people can have their citizenship or their green card revoked, taken away. But the common ones that I see in tax planning, people who renounce their United States citizenship, they do that in person before a diplomatic or consular officer of the United States. The one I see most common is people filing Form I-407 to abandon lawful permanent resident status. It's a very, very simple form. People usually file that themselves. It's important to note, though, that letting the green card expire is not an act of expatriation. So I've worked with a lot of people who are planning to let their green card expire, thinking that that'll expatriate them, or people whose green card expired years ago and they didn't realize they needed to do anything to actually log out of the US tax system. The other common one is treaty election. I don't see people expatriate using a treaty election that often. We use it more as sort of a fail-safe, like if somebody's trying to expatriate towards the end of the year, they file Form I-407, but there's some uncertainty about the timing or processing delays, then we might use a treaty election as of January 1st the following year to make sure that we get an expatriation date that's really close to what they were aiming for anyway. So it's kind of a fail-safe. And this one applies to green card holders only. Obviously, citizens can't use the treaty tiebreaker rules to be a resident of another country. And it only works after long-term resident status has been achieved. In other words, after you've reached 8 of the last 15 years and you're no longer just a regular green card holder, you've transitioned into long-term resident status. If you use the treaty election under the tiebreaker rules before you hit the 8 years, then that just removes that year from your 8-year count. It doesn't expatriate you. So that's also potentially something you can use for planning if you're trying to avoid hitting the 8 years in the first place. So, exit tax, the topic of today. This applies to covered expatriates only. Non-covered expatriates pay no exit tax. So that's kind of the line that everyone's looking at when they're first looking at their expatriation plan. Is there any way I can be non-covered? Because that makes all my problems go away. Just a very helpful illustration. Covered expatriates, exit tax under 877 Cap A. U.S. heirs subject to section 2801. Non-covered, no exit tax, no 2801. As I mentioned a few minutes ago, there are 3 tests for covered expatriate status. The first is the net worth test. If your personal individual net worth, not your joint net worth with your spouse, but your individual net worth is $2 million or more, then you're a covered expatriate. There's also the tax liability test. If your average tax liability for the 5 years before your expatriation year is 206,000 or more, that's the 2025 amount. It changes for inflation each year. If that's the case, then you're covered. Certification test. This is the third one. If you didn't meet all your obligations under Title 26 for the 5 years before your expatriation year, you're covered. So all you have to fail is one of these 3 tests. And that's why I worded it as, if this is true, then you're covered. Because if you fail any of these, that makes you covered, even if you pass the other 2. But if you pass all 3 tests, or you meet one of the exceptions, there are a couple of exceptions I'll talk about in a second, then you're non-covered and no exit tax. This is an old flow chart I've been kind of recycling year after year. Just kind of illustrates what I think is a helpful way to think about the 3 tests. I think it's really important to look at the certification test first. First in order, because if you don't pass the certification test, then it doesn't matter if one of the exceptions applies, you're going to be covered no matter what. So that's why in the first part of this flow chart, where you have the red blocks saying prior 5 years tax obligations not satisfied, if that's the case, then you go directly to covered expatriate status, that's it. But let's say you pass the certification test, next thing you can do is check to see if one of the exceptions applies. Either you were born a dual citizen and you continue to be taxed as a resident of the other country, whatever that means. We're not going to go into that today. But if that is the case for you, or if you were under age 18 and a half at the time that you expatriated, then you can skip the net worth test and the tax liability test. In other words, if you're 18 years and 1 month old and you have many millions of dollars in net worth, if you expatriate right at that point, you're not going to be covered as long as you meet the certification test. So let's assume neither exception applies, which is usually the case for most people expatriating. Next, you check and see, is your net worth below $2 million? If yes, move on. If no, you're covered. Tax liability test is next. And for that one, you check if your average tax liability over the prior 5 years is $206,000 or less. And if that's the case, congratulations, you made it through all the tests and you're not covered. But if you fail that one, covered expatriate. So, covered expatriate means exit tax. And that's what we see in section 877 cap A, A1. All property of a covered expatriate shall be treated as sold on the day before the expatriation date for its fair market value. All property basically means all your worldwide assets, but it's specifically defined in Notice 2009-85, Section 3, where it says any interest in property that would be taxable as part of your gross estate if you had died on the day before the expatriation date as a citizen or resident of the United States. So we're actually looking at the exit tax rules when we're computing your exit tax. Or sorry, we're looking at the estate tax rules. That's what I meant to say when we're computing exit tax. And there's 2 types of exit tax, or in my mind, I like to separate it into 2 categories. There's more than 2 categories, but I think of it as 2 main things. The first one is the deemed sale exit tax. And this is the one that most people are talking about when they say the word exit tax. This apples to most assets. Typo there, should say applies to most assets. The sale price for your pretend sale is the fair market value of the asset. Your basis for the pretend sale is whatever your adjusted cost basis is. And there is an inflation adjusted exclusion that can be applied proportionally to all your gains. The amount is $890,000 for 2025. Common misconception is that the $890,000 is the value of the assets that you exclude, but it's not. The 890,000 is the amount of gains from deemed sale that you get to exclude. So that's actually a little bit better than most people assume. And then this is what I think of as sort of the second category of exit tax. This is all the other stuff that doesn't fit into the deemed sale rules. This is where you have deferred compensation, specified tax deferred accounts, and beneficial interests in non-grantor trusts. Deferred compensation. This goes into the categories of either eligible or ineligible. Eligible deferred compensation basically means that it's a US payer and you filed Form W-8CE within 30 days of your expatriation. If both of those are true, and you've correctly identified the item as a deferred compensation item, then what you have is eligible deferred compensation. And there is no sort of exit tax event for this. Instead, what happens is you agree to have 30% withholding on all distributions, and you can't modify that 30% using any treaty. Tax is then calculated under the normal rules. If you have ineligible deferred compensation, that's things like foreign pensions usually. There's a provision where they can make an election to be treated as a US payer for these purposes. In practice, I've never seen that happen and seems unlikely. I don't really see why they would actually do that. So for ineligible deferred compensation, usually foreign pensions, it's just a deemed lump sum distribution on the day before expatriation. Specified tax deferred accounts is the really painful one. This is IRAs, other accounts as well, but the main one is IRAs. And this is where so many sad situations where I work with a lot of green card holders who are getting ready to retire, give up the green card, move back to their home country, hang out with their grandkids, you know, live a happy retired life, and they roll over their 401ks, which would be eligible deferred compensation, pay as you go 30% withholding. They roll it over into an IRA, which is a specified tax deferred account, and that's treated as a deemed lump sum distribution on the day before expatriation. So it's just fully taxed when you expatriate. And then the last one, beneficial interests in non-grantor trusts, is also a pay-as-you-go 30% withholding. So that's the exit tax. And when people are planning to expatriate, there's a few different things that we look at. So this one seems a little silly to include, but the first option is don't expatriate. If you do not expatriate, you have fully mitigated exit tax. I personally have not expatriated. I am paying 0 exit tax. If you're going to expatriate, try not to be covered. That's the main one that people work with me on when they want to do a planning project. They're trying to figure out a way to avoid covered expatriate status, because it's not just exit tax. A lot of people would be perfectly fine being covered if exit tax was the only problem, because you have the 890,000 gain exclusion. That's going to take care of a lot of people. But the problem is Section 2801. They have the estate tax on the back end. So for a lot of people, basically anyone with kids, there's a huge motivation to try to avoid being covered if at all possible. Third, there are a lot of people who they're going to be covered because they can't give away enough stuff. Either their net worth is too high or too much of their assets are non-transferable. Like, I work with a lot of people who the vast majority of their net worth is in retirement accounts. They can't give those away. So they're going to end up being covered. So they're looking more at strategies for how am I going to lower the exit tax as much as I can. And then the last one, we're not going to cover this one today because I promised to talk about planning strategies for exit tax, but I've certainly had a few clients who come and talk to me for some reason, and then they just expatriate, and it is what it is. So, you know, we all make our choices. We have a little graphic here just kind of illustrating the paths you can take once you make your decision to expatriate. There's kind of this fork in the road, and I do talk to a number of people who seek advice for expatriation who then end up deciding not to expatriate. They say, oh, now that I know what the situation is going to be for my foreign pension, I can't afford this. I'm just going to have to stay a US citizen. That's it. I'll just keep filing my tax returns each year. That's what I can manage. So that's, it's a legitimate conclusion to looking at expatriation. Don't be covered. That's the second one we talked about. It's great if there's no exit tax, no section 2801. That one's kind of the hardest category to fit into in a lot of ways. And then lastly, be covered but minimize exit tax. And a lot of times that one involves accepting some level of exit tax, but kind of shifting your priorities around to set other things up in your future to work really well, to work the way you want, and just paying the one-time exit tax as low as you can, but also kind of also planning to make sure everything else, particularly estate tax, works the way you want it to in the future. And when you're looking at forming an expatriation plan, I would strongly recommend looking at the entire life cycle of each asset in an expatriation scenario. If you're talking about giving it away before you expatriate, then you're looking at gift tax, maybe transfer tax consequences. If you're then ready to expatriate, you're looking at what the exit tax is going to be. And then what's the post-expatriation income tax and filing requirements. And then lastly, when you die, what happens with each asset? And so when you're working on a more complicated planning project, you can look at it and say, okay, well, this is great. This stage of it works well. But what about later on? What's going to happen at the end of the life cycle? So every time you make an adjustment for how you're going to deal with one asset, you have to kind of follow that through all the way to its conclusion or to the person's conclusion to see if the tax results are going to be acceptable at each of those stages. And as I was kind of hinting at, something I want to mention is that optimizing for one thing may mean compromising another thing. There could be ripple effects when you make an adjustment in one part of your plan. And it's important to kind of keep a sense of perspective and, stay grounded in reality here, because exit tax is not the worst thing in the world. It's certainly not as bad as gift tax or section 2801 tax. Gift tax, we're looking at around 40%. Your long-term capital gain rate is 20%, 23.8% if you're adding in the net investment income tax. And also your capital gain tax is on built-in gains, gift tax is on the fair market value of the asset. So, you don't want to over-optimize for exit tax at the expense of something else that's going to be much worse. So, a little bit of detail on my first planning technique, which is do not expatriate. How not to expatriate. So first of all, if you're a US citizen, you can just stay a US citizen. And I've talked to many US citizens who've kind of kicked the tires and done some math and thought about where they're going to live. And they just decided, we can just go live in another country and stay US citizens, or we can have a vacation home, a second home in another country. And if we really like that lifestyle, we can spend as much time as we want there. We just have to file our US tax returns every year. That's a very viable option. If you have a green card, I've also worked with a lot of people who, this is particularly common in scenarios where you have one spouse who's a citizen and one who's a green card holder, and they're trying to decide for the green card holder, US citizen or expatriate. It's got to be one of those two in a lot of situations. So that kind of becomes the decision for a lot of people. And then lastly, you can terminate your green card before you become a long-term resident. So before you hit the in 8 of the last 15 years mark to make you a long-term resident, you can terminate your green card and you're not an expatriate. You're just changing from resident to non-resident. I recently worked with a client who had his green card for 5 years and he's going to terminate it. I think he just did terminate it not long ago, and he's selling stock. He's going to have a $12 million gain on his stock that he sells. And because he's not an expatriate, there's no deemed sale. And when he actually sells the stock, he'll be operating under the non-resident rules and it'll be tax-free. So that's a great planning technique. Just keep track of your timeline as a green card holder and exit before you hit the 8 years. And we've worked with a lot of people on those types of plans. For citizens, if you're planning to keep your citizenship, and really this applies to green card holders who decide to apply for citizenship, what you're gonna wanna look at instead of, optimizing for exit tax and expatriation is just restructuring your assets and income to create a simpler worldwide tax situation. So maybe one of the reasons that you were considering terminating your citizenship is because you're filing tax returns in 2 countries, or something in your life doesn't work well for tax purposes. Maybe, something with foreign tax credits doesn't work right because of the specifics of your situation. So maybe there's a way you can restructure things to create an acceptable reality for yourself as a US citizen. And then the other side of it, of course, is estate planning for the US estate tax. Green card holders. Like I said, a common one that we plan for is avoiding expatriation but still terminating the green card. And I kind of mentioned this a little bit earlier. One thing that people can do is toggle years on and off for long-term resident status by using treaty positions. This is referring to the tiebreaker residency rules in the tax treaties. It only works if you haven't accumulated 8 years yet, because once you've had your green card in 8 years and you make a treaty election, well, that's an expatriation event. But if you're at year 5 and you're going to live in a treaty country for a year and a half or whatever the case may be, then this may be available to you. And it only works, keep this in mind, it only works if you can use the treaty position under the residency tiebreaker rules for the entire calendar year. If you can't use it for the entire calendar year, then you've had the green card in that year for some portion of it, and that'll count as a year towards the 8-year test. So the idea here is before you hit those 8 years, you file the I-407, turn in the green card, and it's just a simple conversion from resident alien to non-resident alien, no exit tax, no 8854, that's it. And so just to kind of emphasize this point, sometimes the solution is to go completely in the opposite direction. So if you're a green card holder and you're looking at expatriation and it's just really not feasible or really not acceptable what the tax results would be, maybe you rolled your 401k into an IRA and it's worth $8 million and that's 95% of your net worth. Maybe you just really don't want to expatriate, you can get US citizenship. And I sort of love this approach just in general in life when you're working really hard towards a goal and you realize, wait a minute, I could do the exact opposite thing and it would solve all my problems. So sometimes that's the case, and we see it in expatriation planning. So sometimes green card holders apply for US citizenship instead of expatriating. That means the US tax filing burden continues forever, but you get the unified credit for estate tax and it makes travel really easy. Whereas if you have the green card, you have some travel restrictions. Mainly just, I don't really mean travel restrictions, but restrictions in terms of the time you spend and where you spend it. You don't have to deal with exit tax. You don't have to deal with section 2801. So, in a lot of situations, this is a perfectly reasonable approach. Okay, so let's assume we're actually talking about an expatriate. The main goal that most people have when they're planning for expatriation is to not be covered. If you can carefully avoid failing any of the 3 tests for covered expatriate status, then you succeed and you don't have to deal with exit tax. You're just filing Form 8854 and it's fairly simple. So the goal here, if you're trying to avoid covered status, is to pass all 3 tests. Certification tests, a lot of times that means amending tax returns, paying any tax, penalties, interest, whatever you need to do to get everything squared away there. Net worth test. The main planning strategy here is to give away assets so you own less than 2 million. Pretty simple. Tax liability test. You're trying to get your average tax liability below a certain number. So the strategies there are, if you're filing joint returns, you can switch to married filing separately. Maybe you can earn less income, pay less tax, and if you can do that for long enough to bring your 5-year average down, it can be kind of a long cycle to get to the point where you expatriate, but I've had some clients do this with the tax liability test. So first, let's take a look at the certification test. Now this applies to any expatriate who fails to certify under penalty of perjury that he's met the requirements of this title for the 5 preceding taxable years or fails to submit such evidence as the secretary may require. So there's a lot to unpack here, but first thing I want to look at is of this title, those words. That's Title 26, that's the Internal Revenue Code. And so that applies to income tax, gift tax, interestingly, employment tax, information returns, etc., but not FBARs. FBARs are covered under a different title. But we'll talk about why you might want to do FBARs anyway in a second. There is no guidance on the certification test. It's just mentioned as 1 sentence in the code. There's no regulations. Notice 2009-85 doesn't really go into any detail. There's no de minimis rules. So within the last couple months, I filed 4 years of amended returns for a client. On 1 year, they owed $3 of tax. On 1 year, they owed $4 of tax. And on 1 year, they owed $5 of tax. I guess the IRS wants those returns because they have not made any de minimis rules. So that leads into how to approach the certification test. I recommend reporting all your unreported income, including those, $21 on a savings account that, I don't know, maybe got lost in the shuffle. It wasn't that important. Nobody's really going to go after you for it, but do you want the IRS to be able to say, gotcha? No, of course not. So report all your unreported income. Fix and file your information returns. That's kind of the big obvious one. If you didn't file Form 8938, you didn't file a 5471, a 3520, those are the things you really need to fix. Obviously pay all tax, penalties, and interest. And my approach is, for the little things, it's easy to fix it, doesn't cost much, won't even cost you much in tax, so why not just do it? And for the big stuff, you kind of have to fix it to be able to say yes on 8854, so you fix everything. Here's just a list of the common problems I see, more or less in order of how common they are. I haven't really done statistical analysis on this. This is just kind of my gut feeling. The biggest one is foreign retirement accounts. Often they require Form 3520, 3520A. Sometimes there's 3 elections that you have to make if you're taking distributions. Unreported bank accounts or other types of accounts that you might not have known you needed to report. That's really the common one I see is accounts, things where you wouldn't have thought, like it's not a regular bank account, but maybe your PayPal UK account had some money in it. That counts as an account, should be reported. And then the other one is really small foreign bank accounts where it's kind of a cascading effect. Someone didn't know they needed to report their foreign retirement account. They had another small account in a foreign country, maybe worth $4,000. They only thought the small account was reportable, but the big, the foreign pension would have pushed them up over the filing threshold. So because of that, the small account is also reportable. That's a really, really common one. Getting community property wrong on married filing separate returns. I don't know how common this is, but I just had a couple bad experiences that I'll never ever forget. So that one makes the list. Foreign corporations, partnerships, disregarded entities, classic information returns, PFIX on Form 8621. A lot of times there's no transactions and all you have to do is fill out the section on page 1 with the basic information. That doesn't get included with the tax return. Or foreign gifts and inheritances not reported on 3520. I don't see that one very often, but it does come up every once in a while. So if we're dealing with a situation where you need to file late information returns, you're going to be dealing with penalty risk. Usually at least $10,000 per form per year is the risk. So you're going to want to assemble a team, CPA for tax prep, controversy lawyer for filing strategy. Streamlined procedures is often a good option unless there are willfulness factors. Personally, I don't see a lot of cases with willfulness factors. It's usually people, usually green card holders living in the US, they have a foreign pension from their previous life and they just had no idea that they had to report it. A lot of times they told their tax preparer about it and the tax preparer didn't report it where they were supposed to. So in a lot of cases, Streamline is a good option. And it can be used for 5 years of tax returns to cover the certification test period, even though the IRS website says 3. I know this because I've personally submitted Streamline procedure submissions for many clients to get their 5 years in, and it was done successfully and they were able to expatriate meeting the certification test. And then something just to think about if it's a good idea to have attorney-client privilege. If there's any chance that your client might need everything covered under privilege, consider getting a lawyer involved early, and they can use a COBEL agreement to engage the tax preparer. And basically there are ways to kind of help narrow down or minimize that risk as much as possible. So the bottom line for the certification test, you're answering the question under penalty of perjury. That has some penalties that we should all be afraid of, but I think the bigger issue is that if you say no on this test, if you say, no, I don't feel like fixing my prior returns, I don't want to pay tax from 5 years ago, that's ancient history, I'm just going to say no on this question, that prevents a perjury charge because I'm telling the truth, but it will invite at minimum an audit, possibly worse, I don't know, maybe there's other things they can find and suddenly you're in a criminal investigation, I don't know, don't do that. Your goal basically is to extricate yourself from the US system cleanly and on no uncertain terms when you're expatriating. So if there are gray areas, things you're unsure about, talk to a tax lawyer, figure it out. Like you don't want to You don't want to just do it, not knowing what you're jumping into. I have a little checklist here for the certification test. Pretty common sense stuff. Amend your prior returns, file missing information returns. This one I said I'd talk about fixed FBAR related overlaps tied to Title 26. So if you're amending a tax return and you're including a Form 8938 with it, where you're reporting all of someone's bank accounts, makes sense to also file the FBAR, especially if you can do it under streamlined procedures where the penalty goes away. You wouldn't want to file to 8938 under streamlined and not file the FBAR, because you've missed the opportunity to make the penalties go away, and you've notified the IRS, here's all these foreign accounts that might not have been reported on an FBAR. Address any community property misallocations. Again, I think I just have trauma from this one. I don't see it that often. Foreign pensions and retirement accounts. Again, that's, really major one. And one last thing to mention, if you fix one thing on an amended return, you must fix everything. You sign all returns under penalty of perjury, stating that you're including everything to the best of your knowledge and ability, whatever the specific language is, I don't remember. But if you're fixing something on an amended return, if you're reporting some unreported income, yes, absolutely. But, maybe you forgot to check a box on Form 8938 saying this account was owned jointly with my spouse. Well, on the amended return, go ahead and check that box, dot all the I's, cross all the T's. So even in the situations where there's very little to do on the amended returns, it's worth kind of taking a look at everything, just an overview, make sure if there's any other issues that you're fixing them. Net worth test. So this looks at, is your personal net worth above or below 2 million USD? Above 2 million, you're covered. Below 2 million, non-covered, no exit tax. So this is a really important number. This is one of the only numbers in the world of expatriation that does not have an index for inflation. So it's the 2 million no matter what. There's a separate calculation for each individual, so you don't include your spouse's assets, and consider marital property laws, pre and post-nuptial agreements, trusts, etc. Liabilities usually are split 50-50 between spouses for purposes of the paperwork, because even if there's joint and several liability, you have to figure out how to put these numbers on the form somehow. Managing net worth with gifts. This is the one that I do a lot of work with. Someone can, before they expatriate, they can make a gift to a human or to a trust. And if you're doing this, you want to be careful of certain rules. For humans, be careful of the rules around gifts to spouses, because in these situations, a lot of times you're not giving to a US citizen spouse. A lot of times the spouse has a different status, so it's not under the unlimited exemption. If you're giving to a trust, watch out for Section 684. That could end up causing a kind of unintended exit tax. And if you are relying on the unified credit when you're making gifts, that means don't expatriate until the following year, because if you make the gift in the same year that you expatriate, even if the gift is before the expatriation date, you lose the unified credit. So gift in 1 year, expatriate the following year. This is just a quick graph, what it looks like before gifting, after gifting, higher net worth, lower net worth, you can get below the 2 million threshold. If you're giving gifts to a spouse, to a US citizen spouse, you have the unlimited marital exemption. To a non-citizen spouse, there's an exclusion of 190,000 for 2025, but really you can give up to the unused unified credit amount and then wait till the following year to expatriate, just like what I was talking about. So common techniques there. And the one that I see over and over is the classic spouses gifting back and forth situation. First spouse gives assets to the second spouse and expatriates. Later, the second spouse gives assets to the first spouse and expatriates. After that, well, they can decide what to do as between themselves. And this works if the gift tax rules in the US and any other foreign country align with your goals and the gifts are real gifts and enough time passes. Like it has to be a real gift situation. You're actually giving the assets away. It unfortunately does not work if most of your net worth is in non-transferable assets like retirement accounts or pensions. And like I said, the gifts must be gifts. There can't be any strings attached. The IRS could say, oh, that's not real. You just gave that $1 million to your spouse last month and then they gave it right back. That wasn't a gift. Or if there's any explicit retained interest, then like I said before, everything that's in exit tax, we're looking at the estate tax rules. Section 2035 covers retained interests and it brings those items back into your gross estate. Anything that's part of your gross estate is subject to exit tax. So you have to watch out for sort of backdoor agreements where you're not really giving something away. If you're making gifts, transfer the titles for assets that have titles, set up new accounts in the recipient's name for financial gifts, file gift tax returns, pay gift tax if that's the plan you end up settling on. The recipient has to report and pay taxes on the income from the gifted assets. And the passage of time is going to solidify the gifts as real. The longer the recipient owns the asset, the more sort of true it is that they have become the owner of the asset. And gifts, of course, are not for everyone. There's a number of situations where they might not be a good idea. If there's like a high transfer tax, or see this sometimes with foreign real estate, citizenship or residency issues, like someone can't carry out a gifting situation that takes a number of years because they're going to have to give up one of their citizenships if they go and live in a different country. I was just dealing with that recently with one of my clients. Here's a fun one. I've talked to married couples where they say, well, I don't want to give to my spouse. How do I know he'll give it back? Well, gifting may not be for you in that situation. And then some people just put a priority on speed. They're not, they just want to get it done, or they don't have anyone to give anything to. So, in some situations you can't give things away. Other net worth reduction ideas. Sometimes I have people sell their assets and pay the tax, take distributions from retirement accounts, pay the tax. This could be useful for people who want to own no assets in the US after expatriation and are close to 2 million in net worth. And sometimes also if the vast majority of someone's net worth is in an IRA and they're going to be expatriating anyway, sometimes it makes sense to just take the distribution. Information reporting. So you have all the normal gift tax return filing requirements if you're giving gifts, but you also have to report substantial changes to assets and liabilities on Form 8854, not very well defined. The 2024 Form 8854 instructions give a little bit more guidance on this than they've given in the past, and there is now a new question on Form 8854. I pasted a little snippet of it on the slide, but there's still no real guidance on what substantial changes means or significant changes means. So this is largely left to your judgment as a tax preparer. Lastly, tax liability test. What the law says. This just looks at your average annual net income tax. The amount is $206,000 for 2025. You're looking at the 5 years before your expatriation year. There's two ways to do this. The easy way, just add up the total tax for the 5 years divided by 5, or you can look at section 38C1 and do the math as directed there. Kind of skipping through these because I'm quickly running out of time. So again, I think I mentioned this before. If you have joint returns, you do not divide by 2. I might not have mentioned that. You do not divide by 2. You take the entire amount from the joint return for each individual to use in the tax liability test number. One way to kind of manage the results is if you can switch to married filing separate, do that for some time. That could, in some situations, bring the average down. The really important point here is that the tax liability test covers the 5 years before the expatriation year, specifically the 5 taxable years ending before the date of the loss of US citizenship. That means that in the year of expatriation, if you have a large income item that's going to push your tax liability way up, it's okay. It's not part of the 5-year test. So I've actually used that as a planning opportunity where someone was going to have a big income recognition event and then make a gift to a spouse. We time that so that it happens early in the year of expatriation. So they still end up passing the tax liability test. Not going to have a lot of time for this one. Technique number 3, minimizing exit tax, but this one's pretty short, so I'm going to try to get through these slides real quick. First of all, if you're a covered expatriate and you're dealing with exit tax, you do get the gain exclusion, $890,000 per individual. So a married couple gets in total $1.78 million in 2025. This applies to deemed sale assets only, so it doesn't apply to deferred compensation, specified tax deferred accounts, all the 401ks, IRAs, foreign pensions, doesn't apply to those, but it does apply to everything else, and it's decently sized number. It can be very useful. The other extremely important thing that I've utilized a number of times is that foreign pensions could be excluded from exit tax. So some foreign retirement accounts or pensions won't be subject to exit tax to the extent attributable to services performed outside the United States while the covered expatriate was not a citizen or resident. So this is a snippet from the code, and then also notice 2009-85 says the same thing and kind of explains it in more detail. So that's been something that's been incredibly useful for clients who are covered expatriates. A large portion of the foreign pensions gets just taken off the table for exit tax. In some situations, lowers the exit tax bill to almost zero. And then another one that's really useful, shifting high appreciation assets without even using gifts. So if you have a married couple in a community property state, they can do an agreement to shift their undivided 50% interest to each spouse owning specific property. And they could put the highly appreciated assets into the non-expatriating spouse's name. The expatriating spouse takes the lower appreciation assets. This can be useful for green card holder couples because they can't rely on the unlimited marital exemption. So, you know, in some situations, this can be a really good way to not give a gift, but still park all the high appreciation assets with one person. Same principle applies if you're going to use a gift. You want to give away the high appreciation assets. If you're a covered expatriate and you can't avoid exit tax, you want to get the stuff off your personal balance sheet that is going to cause the biggest tax result for you. So that's what you give away. And then lastly, the other thing you might want to do is shift the emphasis. Maybe exit tax isn't the worst thing you're going to have to deal with. Maybe you want to optimize for post-expatriation income tax, optimize for estate tax, start looking into the whole life cycle of the assets, because that's really what's ultimately more important than the exit tax bill, especially if you can get the exit tax bill down to a reasonable number. And I think I'm out of time. Am I out of time? I'm out of time. So I didn't cover this last section where things get tricky. Feel free to read through these slides on your own. There's a few good things in there. I offered some simple solutions on them. Sorry, I would have loved to cover those. Feel free to contact me with any questions. I would love to hear from you. Thank you, everyone.